Hello and welcome back to the channel. If you're joining us for the first time, make sure to hit that subscribe button and ring the bell icon. This way, you'll stay updated with our daily insights designed to help you navigate the world of finance. The stock market, a global powerhouse where fortunes shift in the blink of an eye. But where did it all start, and how does it really work today? To understand the heartbeat of modern finance, we must journey back to the 1600s and the dawn of global trade with the Dutch East India Company. This was a time when international trade was expanding, yet managing such an extensive network required immense capital. The Dutch East India Company pioneered an innovative solution that laid the foundation for the world's first stock market. Their idea of sharing profits in exchange for funding brought forth the concept of public investment. In this video, we'll trace the evolution of the stock market from its humble beginnings to the digital age, unraveling how companies raise capital and how investors aim to grow their wealth in this intricate web of risk and reward. History and origin. In the early 17th century, the Dutch East India Company sought to dominate global trade. Managing hundreds of ships across vast oceans to trade valuable commodities like spices, silk, and porcelain required enormous funds. Instead of relying solely on their own capital, the company invited private citizens to invest. For a share of the ship's profits, these citizens became the first public investors, laying the groundwork for the concept of stocks. As these shares were bought and sold in coffee houses and shipping ports across Europe, the world's first stock market emerged. This primitive system allowed the company to fund ever more ambitious voyages, setting a precedent for future businesses. Investors recognized the opportunity to profit from successful enterprises, while companies discovered a powerful way to raise funds. From these simple beginnings grew the complex global marketplace that today underpins our financial system. Rise of the modern market. From the Dutch East India Company's rudimentary market to the highly sophisticated global system of today, the stock market has come a long way. Financial markets have expanded alongside the global economy, developing into the digital behemoths we see today. Entire industries have been born to study the market's intricacies, from finance schools to media networks dedicated to market news. But while the basic concept of buying and selling shares remains, the process has grown increasingly complex. Modern markets now involve extensive regulatory frameworks, digital trading platforms, and a vast array of investment products. Understanding how companies and investors operate in this environment is crucial for anyone hoping to navigate it. Today's market offers a plethora of opportunities, but it also requires a deeper understanding of the financial ecosystem. By learning how these intricate mechanisms work, you can better grasp the challenges and opportunities present in today's financial markets. IPO. Imagine a new coffee company with big dreams. They need capital to expand, so they decide to go public. The first step is to appeal to large institutional investors. If these investors see potential, they sponsor the company's initial public offering, IPO. An IPO is a significant event, marking the moment a company transitions from private to public ownership. The company offers its shares on the stock exchange, and investors can now buy pieces of it, effectively becoming part owners. The initial price is often determined by the company's projected potential, set by underwriters, and influenced by market demand. If successful, the IPO can raise millions, allowing the company to fund new projects, enter new markets, and grow exponentially. However, this exposure to the public market also means increased scrutiny and pressure to perform. It's a defining moment for any business, requiring careful planning and a clear strategy to attract investors. Stock market dynamics. Stock market dynamics revolve around supply and demand. When a company is performing well, more investors want to buy its stocks, driving prices up. This rise in stock price benefits existing shareholders and boosts the company's market valuation, making it easier to raise further capital. However, if the company's prospects dim, investors may sell their stocks, leading to price drops. This ebb and flow in prices reflects the company's perceived value, which is influenced by countless factors. Market sentiment, economic indicators, and industry trends all play a role in shaping investor confidence. These dynamics make the market a living entity, with prices that can change rapidly. Long-term trends often depend on a company's profitability and growth prospects, while short-term fluctuations are influenced by market speculation, economic data, and geopolitical events. Understanding these dynamics is key to navigating the market and making informed investment decisions. Market influences and investor behavior. The stock market is shaped by various forces, from company-specific news to global economic shifts. Market forces such as the price of raw materials, technological advancements, and labor costs affect companies' profitability, influencing their stock prices. Changes in management, regulatory developments, and geopolitical events can also sway investor sentiment. These shifts create daily market volatility, with prices constantly moving based on perceived value and market psychology. Investors often react to these signals, buying and selling shares in response to news and trends. This behavior can lead to market bubbles or crashes when sentiment swings too far in one direction. For example, positive earnings reports can trigger a buying frenzy, driving up stock prices, while disappointing news can cause widespread sell-offs. The importance of long-term investing. Given the stock market's inherent unpredictability, many experts advocate for long-term investing over short-term speculation. Long-term investors focus on a company's fundamental strengths, believing that strong businesses will deliver consistent returns over time. While day-to-day fluctuations can be unsettling, a long-term perspective helps investors stay focused on their goals, weathering market volatility. This approach is backed by historical data, which shows that over the long haul, stocks tend to outperform most other asset classes. By holding on to investments through market cycles, investors can benefit from compound growth and the gradual appreciation of quality companies. However, this strategy requires patience and discipline, as well as thorough research to identify companies with solid fundamentals. Accessibility in the modern era. Once the domain of the wealthy and well-connected, the stock market is now accessible to nearly anyone with an internet connection. Online trading platforms have democratized investing, allowing individuals to buy and sell stocks with ease. This accessibility has empowered retail investors to participate in the market, often with small amounts of money. With a bit of research and a clear strategy, even beginners can start building their portfolios. The abundance of financial information online, from tutorials to expert analysis, has made it easier than ever to understand the market. Many platforms also offer features like fractional shares, enabling investors to buy portions of expensive stocks. Conclusion. From its beginnings in 17th century coffee houses to the high-speed trading floors of today, the stock market has evolved into a complex but vital part of the global economy. Its influence stretches across industries, affecting businesses, governments, and individuals alike. Understanding its mechanisms is essential for anyone looking to invest or build wealth. The stock market offers tremendous opportunities, but it also requires careful study and a level-headed approach. By learning how it operates, you can make informed decisions, navigate its fluctuations, and ultimately use it to achieve your financial goals. Here are 7 takeaways from this video. 1. Historical context. The stock market's roots trace back to the Dutch East India Company in the 1600s, where shares were first sold to fund their global trading voyages. This laid the foundation for modern stock exchanges. 2. The rise of modern markets. The evolution of the stock market has paralleled economic growth, moving from simple coffeehouse transactions to today's digital trading platforms. This transformation has led to greater sophistication and accessibility. 3. The IPO process. An initial public offering, IPO, is the gateway for companies to raise capital by selling shares to the public. This process involves courting large investors first before offering shares to the wider market, allowing companies to fuel expansion. 4. Market dynamics. Stock prices fluctuate based on supply and demand. A company's perceived value can increase or decrease depending on factors like profitability, market sentiment, and external economic influences. 5. Factors influencing the market. Company-specific news, economic indicators, and geopolitical events all sway market behavior. Investors react to these changes, buying or selling shares accordingly, which can result in market bubbles or crashes. 6. Long-term investing. Despite market volatility, long-term investing is often considered a safer strategy. It leverages the market's general upward trajectory over time, focusing on strong business fundamentals. 7. Modern accessibility. The advent of online trading platforms has democratized access to the stock market. Retail investors can now easily buy shares, access market data, and trade alongside institutional investors. Here are 7 practical tips and examples. 1. Understand market history and evolution. Tip: familiarize yourself with the stock market's history to understand its evolution and trends. Example: research the origin of stock trading through the Dutch East India Company and how it has influenced modern practices. This will provide insight into why and how the market operates today. 2. Learn about the IPO process. Tip: study how companies go public through IPOs to understand investment opportunities from the ground up. Example: analyze recent IPOs of companies like Airbnb or DoorDash to see how initial pricing and investor interest influence early trading activity. 3. Monitor market dynamics and trends. Tip: keep an eye on supply and demand factors that affect stock prices. Example: track market sentiment through indicators like the VIX, Volatility Index, and understand how economic news or quarterly earnings reports can create fluctuations in stock prices. 4. Recognize the influence of external factors. Tip: stay informed about news that can affect stock prices, from corporate developments to geopolitical shifts. Example: observe how events like changes in government policies, interest rate adjustments, or international trade agreements impact specific industries and their stocks. 5. Adopt long-term investment strategies. Tip: focus on investing in companies with strong fundamentals for steady, long-term growth. Example: consider the historical performance of companies like Apple or Amazon, which have shown consistent growth despite short-term market volatility. 6. Leverage online tools for market access. Tip: use online trading platforms and educational resources to gain market knowledge and start investing. Example: platforms like Robinhood or E-Trade offer user-friendly interfaces and resources that make investing more accessible, including tutorials and market research tools. 7. Develop a research-based approach. Tip: base your investment decisions on thorough research rather than speculation or trends. Example: study a company's financial reports, industry analysis, and news updates before investing. Look for companies with a clear growth strategy, strong financials, and a competitive edge. By applying these tips and understanding the practical examples, you'll gain a deeper understanding of how the stock market works and be better equipped to navigate it effectively. Thank you for watching. If you haven't already, please consider subscribing to the channel. Your support enables us to continue delivering valuable content like this every day. Let's grow our financial knowledge together.